All right. Hi, everybody. How's it going? I'm Joe Barron, the editor-in-chief of the Review of Banking and Financial Law. And, we've all been seeing what's happening with GameStop. And 2 days ago, I thought, wouldn't it be cool if we use Zoom to have a real-time discussion of what's going on? People are trickling in, so I'm going to give folks a minute or two, do some housekeeping, kind of talk about how the event's going to go, and then we'll take it away. So yeah, I can get started with the kind of housekeeping announcement stuff as people start to trickle in. Thanks for joining us on such short notice. What's been going on is, pretty crazy what's been happening with GameStop. And I know we've got in the audience a lot of law students who may have varying familiarity with, the financial markets and have been hearing about this from their friends in the news. And, we're all digesting it. Stuff is breaking as we speak. So I just wanted to get this great lineup of speakers to give some of their thoughts on it. I do want to plug the official RBFL symposium, which is going to be coming up next month. If you go to our website into the symposium section, you'll get some more info on that. We're looking at the future of banking and financial law under the new administration. If anyone thought that 2021 was going to be relaxing as compared to last year, I think it looks like we're in for a little bit more fun. I also did want to introduce Norm Rickel, who is one of the BU law professors who teaches SecReg. We invited him as his, as in his capacity as a law professor, but he is also a enforcement attorney for the SEC. So I'm just gonna, at this point now, give a really high-level overview of what's been going on with GameStop for those in the crowd who may not be familiar with it. And then our panelists are going to give, a short little 5-minute speech each. We have seven panelists, so it should run about half an hour, 45 minutes, and then we'll try to open it up for a little bit more informal discussion and Q&A. We're living it in real time, so just kind of a nice free flow discussion. So I guess why we are all here, let's see, is the ridiculous situation with the GameStop stock, which the market closed 3 minutes ago, and I feel like weird saying it's only up 67%, And if we bring the chart out, the volatility recently has been insane. Look at the company for what's going here. Is and when investors are looking at that, a lot of investors looked at that and said, this does not look like a great long-term investment. We're going to bet against this company succeeding. So what a lot of sophisticated investors did was opened up short positions, a lot of them by short selling the stock, which for those of you who don't know is when you sell the stock without actually owning it. So you often borrow stock to sell someone else. And with this particular company, the amount of folks who were shorting the stock was, there's more shares were sold that people didn't own than existed. And what that provides is, this opportunity. It opens these folks up to, infinite risk. If the price of that stock starts, really rising, they're in a lot of trouble. If it, drops further, they're looking good, which is where the Reddit crowd kind of comes in. Somebody on Reddit, this came to their attention that there's a huge short interest on this stock. And even a year ago, was kind of saying this is an opportunity to really squeeze the short sellers. And nobody really took that seriously up until recently. But once the kind of Reddit crowd got involved, it really sparked this massive rally and, insanity that's happened. I feel like in the last couple days, we don't know how much of Reddit is to blame, but they definitely kicked it off. And that's not even the whole story, because you have all these folks sitting at home on the pandemic who, because of commission-free trading, there's that element of this where all of these retail investors, kids my age, have access to not only free trading of stock but also complex financial instruments. So at this point, when the Reddit attention turned to the stock, there was a lot of buying pressure. All of these folks who had taken short positions were finding themselves in trouble. And some of these, major hedge funds and were finding themselves in a lot of trouble. And the stock price has gone absolutely wild. Yesterday, some of the major brokerages prevented folks from buying more stock, which seems, wild. The SEC and Treasury have said they're looking into what's going on, and it'll be really interesting to see what comes to this. And with that kind of high-level overview, I would like to turn it over to Professor Jeremy Kress, Professor of Business Law at Ross, Michigan.
Thank you, Joe, and thanks for organizing. This is great to get to talk about these issues with a bunch of colleagues and students in real time. So as Joe mentioned, I'm an assistant professor at the University of Michigan's Ross School of Business. I study financial institutions and financial regulation. I used to be a lawyer at the Federal Reserve in DC. So what I want to do is just make, I think, two pretty narrow observations about two of the many aspects of this eventful week that are relevant to my areas of focus. The first is going to have to do with broker compensation and market structure, and the second has to do with hedge fund regulation. So let me first just share some observations about broker compensation and market structure. So, if you go back 50 years to the 1970s, we had this system where brokers like we didn't have brokers like Robinhood, but stockbrokers were compensated through a system of fixed commissions, right? All stockbrokers would earn roughly 2% of their clients' trades, no matter what broker you were dealing with. In the mid-1970s, consumer advocates convinced Congress that that system wasn't good. It was anti-competitive. It was bad for consumers. So in 1975, Congress prohibited the fixing of commissions. And gradually over time, as brokers competed against one another and new brokers entered the space, that competed down commissions. In the 1990s, we saw the emergence of online brokerages. And all of a sudden, consumers were trading for $9.99 or $5 per trade. Fast forward to the 2000s, and then Robinhood emerges with $0 commissionless trading, forcing all of the online brokerages to go that way, commissionless trading. Of course, the brokers aren't doing this really for free. They're making money, but the way they're making money now is through payment for order flow. Right? They're selling their clients' orders to executing dealers who then profit through the spread, right? And the dealers will then pass on some of that value to the broker, who does not always pass on all of the value to the customer. So the customers are paying for this, right? It looks free to the trader because they see $0 commissions, but the customer's actually paying through slightly worse execution than they would be entitled to. So I think that, in light of this week's events, I wonder if this, effective elimination of commissions in the 1970s and through the competitive process thereafter was actually a good idea, right? On the surface, it looks good for customers, but in as much as free trading incentivizes the Reddit mob to swarm and trade these options and stocks in huge numbers, it might be better to have some sort of fee, some sort of psychological nudge to deter this rampant trading. So in the high frequency trading context, people often talk about a financial transactions tax to prevent excessive trading. I'm not suggesting that we tax Robinhood traders or anyone with a Reddit account, but I do think that if we were to make broker compensation more transparent again, going back to some sort of transparent commission process as opposed to embedding broker compensation in very opaque payment for order flow arrangements, that might at least take some of the air out of the Reddit mob and slow down some of the excessive trading that we've seen. All right, so that was observation number one. Let me just very quickly say that I, like many of others, have found it amusing that hedge fund bros are getting a taste of their own medicine this week. But I am nervous that, and I'm hoping that we don't see any systemic collapses of hedge funds. If we don't see a systemic collapse of a hedge fund, it won't be because we have effective hedge fund regulation. It will be purely a matter of luck, because to this day, we still have no safety and soundness regulation of hedge funds, right? We vowed to do this after long-term capital management in the 1990s. We vowed to do this after Bernie Madoff in the financial crisis. And we thought we did something in Dodd-Frank, but really all we did in 2010 in Dodd-Frank was require more disclosures by hedge funds to the SEC. So the SEC now gets quarterly reports of, counterparty exposures and leverage, but it's not clear that the SEC is getting the right information. It's not clear that the SEC is getting information that's current enough. And it's not clear that the SEC would know what to do with that information if it could interpret it, because the SEC doesn't have authority to impose counterparty exposure limits or position limits or require hedge funds to raise capital or liquidity. FSOC was looking at this. FSOC, the Financial Stability Oversight Council, set up a hedge fund working group. Secretary Mnuchin decided to disband that. So we really don't have any cops on the beat with respect to hedge fund safety and soundness. I hope that doesn't mean that we're going to see a systemic hedge fund collapse. But this experience this week should reemphasize the need to devote some attention to hedge fund regulation. So thanks, Joe. And I alerted Joe that I'm going to have to jump off at 4:45 for another call, but I'm really looking forward to hear what all my colleagues have to say about their observations.
Yeah, awesome. Thanks for hopping on. And up next, we have Professor Yaron Nili from University of Wisconsin-Madison's Law School, deep into the corporate and securities law.
Thanks, Joe. And again, like Jeremy, I want to congratulate you on the initiative and the ability to put interesting this is for everybody. And I think you did a good job of picking people that will cover a wide array of the issues that come up. And that's one of the fascinating thing about this Robinhood thing. It involves so many different aspects of corporate law and securities law that there's like almost infinite amount of stuff that you can talk about. I'm going to focus on maybe taking one step back first of all and trying to situate this Robinhood experiment within the larger context of corporate law and specifically the role of retail investors. So those of you who don't know much about it, Retail investors is kind of a term of art for those investors that invest directly with companies, but are not affiliated with large institutional investors. So if you invest in a pension fund, the pension fund is the investor in the company. You're just a beneficial owner of the pension fund. Similarly, if you invest in a mutual fund, the mutual fund is the one who's gonna invest the money for you. Retail investors that invest directly in companies, as Jeremy said, that has to be done through brokerage who will execute your request to buy and sell. And traditionally, they're viewed as passive, not really participating a lot. I have an article about the fact that they tend not to vote in corporate matters. There's been a push by regulators and academics to try to get retail investors more involved. And in a sense, what we're seeing right now is more involvement of retail investors. And I'll talk in a second about how that might differ from what we would expect. It's also important to say that we are seeing an increase in the slice of retail investors' ownership in companies, which is a reversal of the trend of the last maybe 50 years, where companies started to transform from large retail investors' ownership into more of an institutional ownership. We're seeing now more people willing, because of Robinhood, because of the accessibility that technology gave us, are able to invest directly in companies and basically have a larger portion of retail investors investing in companies. And we can connect that to technology and millennials. And Professor Weber is here on the Zoom. Hi, David. Has written about it and kind of the role of the new millennials in corporate law and corporate governance, and what is on their agenda is not what traditionally has been on the minds of investors. And this is one example of how millennials are kind of using technology and maybe traditional abilities of voice by investors in a non-traditional manner, right? So what we see here is a lot of the GameStop issue is basically driven by this effort to show it to hedge funds, right? And Elon Musk has kind of joined the train and kind of like fueled the fire, but there's kind of one component of people are making money out of it, and maybe some sort of a pyramid scheme in the sense that you keep on bubbling until the bubble explodes. But some of it is actually an attempt to show social activism by targeting hedge funds who are shorting and showing them off or teaching them a lesson. And I think that has both good and more concerning aspects to corporate governance. I think on the positive side, as I mentioned, people like me and the regulators have been really keen on getting the Main Street investors, retail investors, more involved in corporate law. And we're seeing them getting more involved, maybe not in the ways we anticipated to be, but they are starting to act more, and maybe there's a way to channel it to more productive venues. I think also in the broader sense, I think my view is that shareholders overall are very well situated to advance social causes, ESG matters, and this is one way to look at it, where basically with the power of buying, they are sending a message that might be able to percolate even deeper. On the concerning side, and I think some people will talk about it, there is obviously the legal concerns of stock manipulation. There's a concern that you're creating a bubble that will actually burn investors in a way that actually would deter them from the market in the future. So I would hate to see a lot of people losing their money and shying away from the market for good after being burned by an experiment like that. So I'm going to conclude here and yield the floor to our next speaker. Again, thank you everybody for a very interesting panel.
Yeah, and Edward conference.
Joe, you've been breaking up a lot, and I think not just for me. I think you're breaking up a lot for everybody. So I wonder if it might be, you might want to turn off your camera or maybe announce the next speaker in the chat or something, or sorry about that.
Thanks, Professor Weber. Yeah, I'm probably taxing my internet setup with the double live stream.
Well, you came through quite clearly just now, so maybe that's the way to move ahead.
Gotcha. So yeah, now we have Professor Ben Edwards from UNLV's Boyd School of Law. Welcome, Professor Edwards.
Excellent. So first, thank you, Joe, and thank you as well to the Review of Banking and Financial Law. It's a fantastic publication. This is an issue that sort of hits near a lot of my areas of interest. So as a quick way of background, I began law practice as an associate at Skadden Arps, focused on securities class actions representing hedge funds. Most of the work I did was arising out of the Madoff Ponzi scheme. When I left, decided to become a law professor, my first gig was at Michigan State as a fellow, and there I began to run a retail investor-focused law clinic. And that perspective, seeing both what happens on the hedge fund side and also what's happening to retail investors has really informed a lot of my work. And so with that, I want to talk about what we're likely to see in legal actions arising out of this. In particular, there are a lot of people who are really angry about what happened yesterday with the trading stops and the limitations on trading, and what's happening today with limitations on trading. People are not able to buy in the quantities they would expect, but at the same time, sell orders have been facilitated. So many of these individual retail investors, if they're upset about it, or they're upset about what happened, if they want to bring some kind of claim, they're going to have to go through what's an industry-controlled arbitration forum, the FINRA arbitration forum. So every investor who's buying stock through a brokerage has signed an account opening agreement. Generally, that contains a pre-dispute arbitration clause. You have to arbitrate all your individual claims through FINRA. So that means most of these individual cases are going to be channeled into the FINRA forum. So one thing that's interesting is that class claims are treated differently than individual claims. While most businesses that are using arbitration agreements are now also including class action waivers, so you can't bring a class action, FINRA does not allow its member firms to include class action waivers. So you can pursue a class action against Robinhood, Interactive Brokers, or these other firms, but you can't, so you can go to court in a class action, but if you have an individual claim, you're not going to be able to pursue it in court. So on the class action claim front, it's going to split in a couple of different ways. Anything that's filed in the federal court system, I would expect all of those cases to get consolidated before one federal judge at some point, because they're all arising out of the same controversy. There's a decent likelihood that the Private Securities Litigation Reform Act will be applied, and you're not going to be able to get discovery in federal court until after you get past some kind of motion to dismiss, or you proceed somewhere. So that's going to be challenging to do. There's also the possibility of state court class actions here. Now, this is going to be challenging because there's another law that a lot of people have never heard of called the Securities Litigation Uniform Standards Act. So if you allege a state court class action under state law, and it includes allegations of misrepresentation or some fraudulent omission, that's going to be barred by SLUSA. So you can't do that. So a breach of contract class action, I'm not sure how well that'll fly at the state court level, but something like that might potentially work. The other big piece of action I think we're likely to see coming out of this is going to come from the regulators. I expect we're going to see action from the SEC looking at whether or not there was market manipulation in connection with this. So market manipulation is broader than just your regular Rule 10b-5 fraud claims. So the SEC will certainly look to see if people said things that were not true, and they might bring some kind of fraud action. But if they can establish that people were trying to force other people to have to enter into transactions by their transactions, they might characterize that as market manipulation under the Exchange Act. So what's probably going to happen is the SEC is going to do what it does, and that's send subpoenas. And it's going to subpoena Reddit, it's going to subpoena Twitter, it's going to subpoena all these forums if it can identify people who are posting memes and other things, and it's going to seek to access their communications. You may not even receive any notice if your communications are swept up in this inquiry. I would expect that the SEC, if it sees things that look to it like market manipulation, it may take action. I wouldn't expect it to take broad action against everybody who's been trading, But I would expect it would depend on exactly what people have said. I'd also expect state regulators to be involved to some degree. I expect Robinhood, Interactive, and a lot of other brokerages that facilitate a lot of retail trades are probably already getting inquiries or will soon be getting inquiries from state securities regulators asking questions about why they stopped trading. It'll be interesting to watch all of this play out in the coming days. And although there are big implications, for scholarship and for the rule of law and what's happening in this space, I think we can all agree that it's absolutely hilarious, and I think it's going to be fun to watch as it plays out.
Thanks, Professor Edwards. Yeah, the meme culture of Reddit is, you throw enough content out there, you got a lot of creative minds at work. So thanks for your thoughts. Up next in our list, we've got Professor Brian Quinn from my alma mater, BC Law. I didn't live on Newton campus as an undergrad, but got over there every once in a while. So welcome, Professor Quinn.
Oh, well, thank you very much, Joe, for having me, and thanks to the review for putting this together, this real-time panel. It's quite a group you've got. I want to think about this a little from about the narrative that's playing out in front of us, because this is all just happening right now, and questions about like who's going to get sued and what the SEC is going to do, those are still kind of down the road. But right now, the thing that we're seeing in front of us is this narrative that's getting played out in the press, getting played out online, and I guess Robinhood is the right place for it to happen, and Redditor, because it seems to be this idea that the little guy will take down the big bad hedge funds, and that's motivating a lot of energy around this whole issue. And I think even for us watching this, and when we got to look at this, there are all these little guys taking down the big bad hedge funds. And so it's an interesting narrative. But why? Because it harkens back to this idea that we have that financial players are the bad guys, right? And that they're predatory and will find good companies doing good things and will just take them down for financial gain. Now, that may be true, right? But is that true in the case of GameStop? I mean, you want to think about GameStop for a second. GameStop is a lot like what Tower Records was years ago, right? I remember Tower Records used to go down there and hang out, and look at records, flip through the old LPs, right? But that all became digitized, and then Tower Records went away, right? And GameStop is in a similar business, right? You go down to GameStop, you look at all the games, but that's all getting digitized, and that's all going to go away. And there's not much that you can do about it. So the shorts really are there to push that forward, right? They're trying to push all that forward, and I get that. Now, if you go back and you look at watch the original video from Roaring Kitty, which I did today, which was, went back and watched a bunch of his videos. He's got kind of a really modest investment thesis with respect to GameStop, right? He recognizes that GameStop is not going to be around forever, but it's got one last go, right? And it might survive for a little while longer. And here's an opportunity to make a little bit of money, right? And that was his original recommendation, kind of a reasonable recommendation for someone who wanted to take a risk. So you've got, on the one side, professional investors, these shorts, and then you've got a sophisticated group of people, right? Because I guess the original recommendation, came along with like a $50,000 investment. So if you're the kind of person who could put $50,000 into one company in one investment, that's the kind of investor you're talking about. So not someone who's not sophisticated. But then in the recent month, we have this movement by unsophisticated, retail investors, right? People with a little bit less sophisticated, maybe less assets. And those are people who are coming along for the ride. So you think about this narrative, this anti-establishment narrative. And, I think about what's going on in our country generally, where we've got a kind of an anti-establishment populist narrative in all sorts of fields. Politics, for example. Let's go storm the Capitol. We got a bit of that going on here, right? But like in politics, as in finance, the elites are on both sides of this deal, right? And when people are left holding the bag, my guess is that the shorts will find a way to cover themselves. And the early long investors and the institutional long investors, they're going to be fine too. But maybe that 17-year-old or the 25-year-old who put down $2,000 at $200 or $300. Sometime next week, they're realizing they're holding $7,000 worth of stock that's basically worth $18 a share. And I worry about those people. I worry about the effect of what that has, what that'll have on investing going forward. Because this narrative, this anti-establishment narrative, we have to remember that there are parties on, the elites are on both sides, and the kind of normal people like us are in the middle, doing what we typically do. So that's all I have for today. But it's a very interesting conversations going on.
Yeah, thank you for your thoughts. It's crazy what's going on. And up next, we are going to move to Professor Elizabeth de Fontenay from Duke Law. Focuses a lot on corporate law, private equity, and hedge funds. Welcome, Professor de Fontenay.
Thank you for having me. And I think Brian's discussion was actually a very nice lead-in to what I'm going to talk about. So I have the unenviable job of defending the forces of evil. So I'm going to defend the hedge funds that are shorting GameStop stock and other companies' stock, and just try and help a little bit with people understanding what exactly is going on here. Who's the good guy? Who's the bad guy? Is there a good guy or is there a bad guy? So just stepping back a little bit for people for whom this is not entirely fluent, all of this language, I'll talk first about what shorting means. So shorting basically just means making some investment or some bet that will cause you to make money if the company's stock price goes down relative to what it is currently. So there are a few different ways to do it. The main one is called selling short, and Joe explained quickly what that was. I'll just say it again. When you sell short, you borrow whatever company's stock you're looking at. You borrow it typically from a big mutual fund company, for example, that has a bunch of that stock that it owns and is trying to make a little extra cash from doing these transactions. So you borrow it from them, you sell it on the market, all right? So you think the price is here now, you sell it at this price, and you believe that the price is going to fall, right, in the meantime. So you hopefully later, when you're supposed to get that stock back to the mutual fund, you buy it back hopefully at a lower price and you make money based on the difference there. So that's selling short. So the main question people want to know is, are hedge funds that short the GameStop stock hurting GameStop? Right? That seems to be at least some of the Reddit crowd's view, is that this is so mean to GameStop, this is bad, we've got to put a stop to it. Are they hurting GameStop? The short answer is no, right? And the reason is that, and this is something that not everybody understands intuitively, all of this trading in the company's stock and in derivatives around the company's stock has to do with the so-called secondary markets, right? So let me try and explain. When a company raises capital by, say, when it does an IPO, for example, there it is actually taking in new money from investors and giving their stock to them, right? All of this trading that's happening here does not involve the company on either side, okay? When you go out and you buy stock today of GameStop, you're not giving the company any money. You're just giving money to somebody who holds the stock currently and wants to sell it to you. You're giving it to another investor. Conversely, when you sell the company's stock, you're not hurting the company in any way. It doesn't involve the company directly at all. Okay, so no money is going in or out of GameStop from any of these transactions. It's kind of a basic point, but one that people miss a lot, right? So stepping back from that, I would generalize by saying shorting, right, making a bet that the company's stock is going to fall, does not cause companies to fail. It's the other way around, all right? What happens is some hedge fund out there believes that the company is actually doing poorly, right? It's doing worse than the market seems to appreciate. And so it decides to short the company's stock, which means that if the stock actually does indeed fall, they will profit from that. Again, that does not directly harm the company in any way. If the company is doing poorly, it's because the company is doing poorly. And I think people can appreciate why GameStop is doing poorly as a result of the pandemic or otherwise. Okay, it can indirectly cause some problems for the company. For example, if people see all this shorting activity and then suddenly it becomes hard for the company to raise capital if it needs more. But the only reason it would make it harder for the company to raise more capital, say by borrowing money from the big banks, is if those big banks actually believe that the hedge funds are correct, okay? So it's only if the hedge funds are correct that things are gonna be hard for the company. And again, the reason that it's gonna be hard for the company is because the company is doing poorly, right? So But hatred of shorting is very widespread. And so where does all of this come from? What explains why people think that shorting is bad? It primarily comes from the managers of companies, of big public companies. They hate it when their stock is shorted. Why? These are people with massive egos, right? That's one reason. And they don't like any suggestion that their company is overvalued. So Elon Musk would be a classic example of this. He has a pure hatred of anybody who shorts Tesla stock, and lots of people question whether it's justified or not. And another reason is that a lot of corporate executives have options tied to their stock, and so they actually, their compensation will go down a bit if the people see the shorting, and it actually does cause the stock price to fall. All right, so I will close out really quickly by saying that shorting can actually perform a highly beneficial role in the markets, right? What people don't seem to appreciate is that at any point in time, right, and especially when lots of retail investors are involved in the market is much more likely to be overvalued than undervalued, okay? So actually anybody who's out there sending a signal that, hey, market's overvalued, you guys might need to course correct a little bit, that is actually very useful information. So the positive view of short selling is that it conveys very useful to the markets and actually is a course correction for when the market, as it often does, gets a little bit ahead of its skis, right? So in terms of policy solutions here, I would not ban shorting. I think that's a very bad idea and will only make sort of these bubbles that we see in the market worse. The solution would actually be to get retail investors, move them back. As Yaron suggested, they were getting out of investing directly in stocks. Now suddenly they're all back in as a result of Robinhood. I'd suggest trying to find ways to get them back into indirect investment, that is to say, investing through mutual funds and ETFs. And I will stop there.
Thank you very much, Professor DeFontenay. Up next, we've got Professor Anat Allen-Beck out of Case Western today, who focuses a lot on corporate law and entrepreneurship.
Sorry, I had to unmute myself. So first, thank you. This is the first time that the two men in my life actually expressed interest in what I'm doing and talking about today. That's my son and my husband. My son, because he loves GameStop, so he kept hearing me discuss GameStop. He actually loved that store in the mall. Unfortunately, we don't go as much to the mall these days. And two, my husband came home a few days ago and told me that some of our friends made a lot of money. Now, we do have friends that deal in trading, but those were not the friends that he was talking about, okay? So there's a lot of interest in what's going on. And I have actually 4 talking points. So I'll kind of make it a brief. One is this gut feeling that I have, and I think that it was actually Matt Levine that tweeted about it today as well. Is there some sort of a professional intervention as well? There's no doubt that the Redditors started this, but is it possible, we need to have more investigation into this, that other professional fund managers continued, right? So that's one thing that I think the SEC is actually looking into. 2, with regards to corporate governance, and I'm going to build on what Elizabeth just described, let's talk quickly about the executives, right? So what happened is that we have these long struggling companies, right? And for example, we have GameStop, BlackBerry, Lacroix makers, and all of a sudden, their executives, their CEOs, their directors are sitting on big stock gains, right? So if I was their lawyer, I would probably have to advise them, what do you do? Can you sell? Okay, now, according to the Wall Street Journal, only a handful of some top executives and board members, for example, at GameStop and BlackBerry, have sold shares this month, okay? Many of them did not. And I'm not surprised, and I suspect that they will not. And I also suspect that the SEC is probably not going to view that positively, if they will. Okay, so you also have this challenge is that you have these insiders that might be able to, but are now probably afraid to sell. The other point that I wanted to make is with regards to policy. Okay, so what part of a company's float can be shorted? Okay, so currently, and again, according to my understanding, the amount of shares that are shorted can actually exceed over 50% of the float in a company. Okay, so I wonder if the SEC is going to do something about that. I wonder if, now we're going to have a new commissioner, if he's going to go in and do something about that. Okay. A few other things with regards to the SEC, and that is with regards to disclosure. Okay. Currently, there is no duty to disclose one's short position. Okay. And I know there are calls recently, especially coming from a friend of mine in Colombia, Josh Mitz. Josh also did some research on Seeking Alpha. And some of these calls are asking the SEC to have a voluntary short position disclosure, okay? That's going to reflect holding and trading intentions, okay? There's also, I just wanted to point out, there's another new paper by Barbara Bliss, Peter Malk, and Frank Patron, who argue that negative activism play an important role to traditional activists in enhancing price accuracy, okay? And of course, I also wanted to discuss Elon Musk. I love Elon Musk. Yes, let me tell you a little secret. So while I was doing my JSD at Cornell, on the side, I also worked with an organization. What I did, because I had this legal background, is I monitored the tweets, okay? So what's happening with his lawyers? How did they let Elon tweet what he did? And why do I say that? Because he has fiduciary duties to his own investors, right? And so I think with social media, and I tweet as well, corporate counsel has to take that into account. Okay, did they go over the tweet before? What are the ramifications? I'm sure it's going to put him in hot waters with the SEC. So on the positive note, there's a lot going on. A lot of us can write a lot of nice papers, but I do think that there's a need to also take a look at what's going on around us. Just one quick last point, and that is currently there are short selling bans. There are under considerations, for example, in South Korea, Germany, France, Italy, also in Turkey. And so I just warn what's going to happen here, okay? What are the next steps? Are we going to overregulate this as well? Those are my points. Thank you.
Professor, yeah, and I look forward to seeing all the papers that come out of this, between the Fed's actions with the coronavirus pandemic and GameStop. There's a lot of material out there these days. Mm-hmm. So our final speaker, I know, had an event before this and was going to be hopping on soon. I don't see Professor Kathy Huang on the roster just yet. I'll keep an eye out. But in the meantime, I figured then I would start to open the floor to questions from the audience. Y'all can do so in chat, or if you want to raise your hand with the raise hand function, I'll try to see that. But I guess if any of our panelists have any thoughts, if you want to kind of respond to each other.
Well, I'll go ahead and jump in with something I meant to say, but forgot to say during my presentation. For the cases that do go to arbitration, if you bought early, the market had been going up, and then suddenly Robinhood sold you out because maybe you had a margin position or something else, and Robinhood cashed out your position. As long as you didn't actually lose any money on the trade, it's highly unlikely you'll be able to recover anything in FINRA arbitration. So it's going to be a challenge.
And then we got a question from the chat for Professor DeFontenay, which I'll read out for the crowd. So assume we agree that shorting is an important market signal. Also assume we disagree that the policy answer is a paternalistic view of retail investors that says we should push them not to invest in stocks. Could you talk about disclosure of shorting by hedge funds as a policy proposal and the extent to which such disclosure makes the market signal of shorting more clear?
Great. So that's a fantastic question. So One thing I didn't mention is a sort of second reason why people don't like shorting is that there is occasionally fraud involved. So someone will say, they'll post on Reddit, for example, oh, I have a cousin who works at such and such company, and he says that they are cooking the books, or their product that's about to come up is going to be a total failure. So everybody should, this company is going to fail. And so it turns out that before that rumor came out, this person was, had purchased put options or was short selling the stock and was going to make a lot of money if other people follow this and and the stock price goes down. And it turns out it's all fake, right? One thing to note about that is that these days that tends not to be the hedge funds that do that because they have legal counsel and they know that that is fraud and they will get in big trouble for that. It actually tends to be small investors that do that kind of thing. But we also know that that happens in the other direction. And some of that is what we're seeing right now with Reddit of people trying to boost company stocks with claims that are not necessarily true. So the fraud goes in both directions. So one option is force people to disclose, right? If you short a stock, you need to come out and say it. That way we can sort of assess whether you have conflicting incentives with respect to things that you do and so on. I actually agree with that. So I agree with various proposals that have talked about disclosure of positions. Hedge funds, for them, it's a little bit challenging because they always or often want to have a position confidentially so that they can make money off of their trading strategy. But if they've already purchased it and they're required to disclose right after, then I don't see any problem with that. So I actually agree that that's a good policy. The second part of the question is, do we really want to kick retail investors out of this? Do we want them to not invest directly in stock? And I'm going to push back a little bit. I'm going to be a little bit paternalistic. We have a long history of retail investor performance relative to how they do when they just put their money in index funds or index ETFs, right? And there's no comparison, all right? Retail investors get killed in the markets. And so to the extent that sort of that's somebody coming in there, with their eyes wide open, then you can make a case for it. But my sense is if small guys end up losing over and over again, at some level, the rest of us bear that cost, right? If we have to pay out more money to people in retirement and so on, whatever it is, we know that overall they get killed. And so my view would be, let's try and help them make the right decision. We don't have to make it illegal for them to invest directly in stocks, but give them more incentives to invest indirectly.
Awesome, thank you. And I know, Jeremy, you've got to bop off, but someone put a question through the chat. I don't know if you have time to answer.
Yeah, so I'm just about to hop off here. I was typing out an answer to Josh's question about what happens if we change broker compensation model. The short answer is I haven't thought about it closely enough. This is 48-hour off the cuff reasoning. I don't think moving from payment for order flow to a commission model, I don't think would necessarily change the dealer business model substantially. For brokers, it would just change the way that brokers are compensated rather than payment for order flow. They'd be compensated directly by the traders. Dealers, I imagine, would still make markets. They wouldn't have advanced access to customer orders. So, perhaps they widen their spreads to account for that, maybe. But Josh, I need to think more about it, and perhaps we can chat offline. So, one of the big lessons of the past 50 years in market structure is, getting rid of fixed commissions had unintended consequences. And if we go back to commissions rather than payment for order flow, there would undoubtedly be unintended consequences as well. I think that's what Josh was referencing. And, it would be important to think that through a lot if we were to take my recommendation seriously. So I do have to hop out for this other call. Thank you, Joe, for the invitation. Thank you to the fellow panelists for all your great insights. If you haven't read Ben's post on the Business Law Prof blog, do so. I'm sure Anat has like 3 Forbes articles in the works. And I can't wait to read all the scholarship to come out of this. Thanks, everybody.
Thank you, Professor. So I'm going to take a couple hand questions and then bounce back and forth to the chat. So you're on. We'll call you up.
Oh yeah, I was just I think it connects to that debate that Elizabeth, Professor De Fontenay, and the person from that asked the question had about the retail investors. I take a kind of a middle ground view. I think there is value for sure for retail investors to own stock directly for the right reasons, and in sometimes when they have some some sort of a different stake in the company other than just wanting to make a quick buck, that could be very helpful. What I would be concerned about, and I think it could be concerning here too, is that what we're seeing here, kind of like the game of tit for tat, where people kind of, driving the price up, but then, there's going to be a counter move, might drive not just retail investors from the market or from specific stock, but some other valuable players. You know, investing in GameStop right now is just it's gambling. It's just like you might as well just go to a casino and put your money on the lottery. It's just not, you don't know how things will turn out because it's not a logical type of investing. It just who is going to be at the upper hand of like in getting more people to watch the TikTok short segment. So in that sense, I think there's a cost here with the way this has been conducted of potentially creating some deterrence from people just participating in the market for the right reasons. That's what I wanted to say.
Thank you. And we did get our final presenter, Professor Huang, who comes to us from UVA Law. Welcome. Yeah, if you want to just give a quick spiel.
Oh, I was going to say I have been delayed so much in my previous call that I don't have that much to say, and I'm afraid that I would just repeat things. But I will plug the fact that Professor Edwards was my office mate when we were practicing, and anything he writes is awesome. So you should just read his blog post. And I'm just going to second it, even though I haven't had a chance to read it. So don't let me down, Ben.
Well, fortunately, I don't take any hard position in it, so you're in the clear. Good,
just like a good ex-litigator would.
So I guess I'll move on to another hand question. One of RBFL's star 2L students, Colby, you want to fire away?
Definitely, thank you. I think I sort of have two questions, but I'll try to consolidate them as best I can. So I guess primarily, I'm just wondering how much consideration everyone's giving to the idea that a lot of this might actually be natural. It seems like we're sort of operating on the premise that this is like mostly artificial, that there was manipulation, especially on the upside from like social media, especially Reddit and Wall Street bets, etc. And I guess I just want to point out a few things, like for example, so Keith, the Roaring Kitty, who I think it was Professor Quinn alluded to when he sort of explained his initial long position. I think Professor Quinn said it was quite modest, and like the words he used were pretty modest and the numbers he gave were pretty modest, but he was also very clear that he was giving like pessimistic, like his discounting of future revenues was very pessimistic. A lot of the things he was doing were sort of like the low end of what he thought was possible to be sort of conservative. But if you listen to like the tone of what he's talking about and a lot of the things he was pointing out about why fair value was way above basically where his position started, he seemed pretty confident. He even said several times that like he doesn't shoot for 3 or 4x on his plays. He shoots for 50 to 100 baggers. And he was very confident that this was, and that was when it was at $4 and change in July. So like if you say he was shooting for 50 times on that would be, stock price of 200, which isn't that far from where it has leveled out at points in the last week or so. And he pointed to tons of positive change. So the console refresh is a guaranteed catalyst, and then several other potential catalysts. And I mean, even their cash on hand at one point outweighed their book value. Just tons of things that suggested that it was super undervalued. And he was pointing to a bunch of catalysts, and he got almost every catalyst plus extras. Like Ryan Cohen come in and who is a certified like e-commerce genius. He sold Chewy for $3.3 billion. And was running e-commerce businesses when he was 14 and 15. So I guess I'm just wondering where people stand on the idea that maybe this actually isn't that outside the realm of realistic natural possibilities from from a lot of crazy things happening in a short amount of time. And then sort of tied to that and related to the idea of shorting, I'm just wondering if anyone could speak to the like regulatory landscape around short interest, because I know naked shorts are supposed to be illegal, but it's hard to enforce for various reasons. But there's been short interest like around and over 100% on this for a long time of the float. And if there was 140% of the float was shorted, how was no one looking into the fact that obviously means there's tons of naked shorts out there, I guess, which are supposed to be illegal as far as I know. So yeah, that was a lot, I know, but I'll just throw it out there.
Nat, you had mentioned if you're wondering how much of the recent activity has been from professionals. If you want to touch on the kind of normalcy point, and then Professor DeFontenay, if you want to, tackle that second part.
Sure. And what I'm going to do, I'm even going to send you a link, okay, to a great post from today that came out by Matt Levine showing the numbers. And why do I say that? But I have to say, I started thinking about it yesterday. The fact that look at the percentage, it's really aggressive, okay? Yes, it probably started with Redditors, but what happened afterwards, okay? Are there also is there professional money behind what's going on? Basically piggybacking on what's happening. And I think we need to take that seriously into account and do a serious investigation. And actually, let me tell you, the SEC is already looking into that. And they have an entire department on the dark web, and that's what they're looking at, okay, to see if there's professional money behind it as well. And one more thing, I think the SEC also needs to update its overall guidance on manipulation, right? Or maybe issue some guidance to a rule or a release, or do something, okay? Tell us what you're thinking. Now, there are controversial areas, right? This is not the first time. Just look at intermediaries like Seeking Alpha, okay? So the question is, what do we want to do about those types of situation, okay? And that's where I would look into, and I'm going to send you the link now. I want to give some other people an opportunity to talk.
I guess Professor DeFontenay, Colby had mentioned, that legality of the ridiculous short interest, kind of what you think regulatory action should be, if anything.
Yeah, so I think somebody who actually teaches securities regulations is going to have to help us out. Ben, you might have to jump in. I had also thought that naked shorting was illegal, but maybe there's a sort of threshold above which, if you have enough assets, you can do naked shorts. So I actually don't know the answer to that question, and was surprised as well. On the earlier question about the value, what is the proper valuation of GameStop? It's an interesting question, right? It is possible that one person on Reddit is right and everybody else in the market was wrong. It seems somewhat unlikely, though. So you have professional analysts who are looking at companies' cash flows constantly. They're looking at other companies in the same industry. And so the question I would always have in these instances, why do we have any reason to think that this person is correct and everybody else is wrong? After the fact, it may be true that this person predicted the future development of this company and others didn't. But markets are forward-looking, right? We have to make an expectation of a company's cash flows from what we know now. And so this extraordinarily optimistic view, sort of having the company's stock price just wildly outpace its current earnings, just seems unlikely. Again, could end up after the fact having been true, but seems extraordinarily unlikely.
Awesome, thank you. And I'll take another question from the hand raised field. Tony Casey, if you want to ask, I'll follow that up with Michael Taylor, and then I'll jump back to some of the chat questions.
Sure. So my question is really for Elizabeth and maybe a little Ben. Two parts. I wanted to push back a little on the companies don't get hurt by the shorts. And I think like in a kind of perfect economy when things are going well, that's got to be right. But like, I think AMC might have been saved by this whole thing this week because their stock quadrupled. It gave one of their creditors who had just turned $100 million of debt into $4 options. They've issued stock. They might issue stock again. this might finance their bankruptcy in a way that Hertz wanted to do in June. And, GameStop might have also been on the brink of failure. So like, these are all firms that are about to collapse. And so then like, they are trying to raise money. So I wonder, I'm not sure that's good that they should, right? It might be like, we don't want them to raise money that way, but they are being hurt in that sense. I wonder about that.
But, yeah, no, that's a great point. So a couple of things. One is, if all these folks are really trying to help GameStop, what they should do is write a check to GameStop. They shouldn't actually be trading in derivatives around GameStop. The second is, I agree with you to the extent that this means that the company can raise more equity capital, right? If they can convince these same people to do a new issuance and to participate in it, then yes, you can rescue them. But again, if we believe in efficient markets, then we think before all these folks came in, the price was at least somewhat accurate, and that price suggested that these companies were failing. So if anything, my prediction would be that this would be even if they are able to raise more financing, that's going to be a temporary lifeline and not something that's going to sort of rehabilitate the long-term health of the company.
And my second question, and it relates to your regulation point and Ben's investigation point. Let's say we agree with you. The politics is really, really hard, right? Like, we didn't regulate over the summer when people lost money on JCPenney stock. We didn't regulate with the Volkswagen squeeze when it was too sophisticated parties. If we decide to regulate, the government decides to regulate now, I almost think they can't, right? I think that the outrage from people who are like, why are you choosing the moment when the sophisticated ones lose to say we got to protect the unsophisticated? Like, we've been Elizabeth Warren's been telling us this for 10 years. And now weirdly, AOC's on the other side, right? Like, the whole thing is so bizarre. And and like investigating, if states start investigating this, I think they're going to really shoot themselves in the foot if they start sweeping Redditors' emails. Like, you talk about mobs of people who are upset. These people who made millions of dollars, maybe think they've still got it, maybe they will lose it on Reddit, are going to be regulated and have their emails swept. Like, wow. It seems totally like we got to wait 5 years and then come back to this kind of thing.
Ben, I've talked a lot. Do you want to jump in?
Oh, I'll jump in. So I put a guidance on Reg SHO in the chat. If you're wondering about the rules governing short selling, it's Reg SHO. I'm not a huge expert in it, but it'll help get some understanding of what's allowed, what's not allowed. I do think that we're going to see some investigations. I think they're going to be sweeping, subpoenaing. I suspect that they will exercise that discretion they have about who to go after. If they go after anybody, it's going to be something egregious. But outside of that, I think you're right that the optics on it are not good. And I wouldn't want the SEC to only get involved when sophisticated parties lose. But I do think they're going to take a look. And I think the state securities regulators are also going to be taking a look. But they're not just going to be looking at the Redditors and the retail investors. I think they're going to be looking closely at the brokers and their decisions to slow down trading. Some of these brokerages have significant equity investments from high frequency traders and hedge funds who may have been on the other side of the trade. I think they're going to look at that. I don't think they're going to find anything necessarily, but I do think they're going to poke around and give it a good sniff.
And thank you. If I can also add something, to me, honestly, the issue here is that I don't think we have clarity on what part of a company's float can be shorted, right? What's the amount of shares that can be shorted that exceeds the float of in the company? Okay, and I think we need to at least see some guidance on that. Okay, what's going on? That's one. And and look at this crazy volatility. I mean, I think this is something that, to me at least, it's concerning, right? What's going on? Is it really just, people who are retail investors that are making money off of what's going on or more? And also, I've also been following social media, and there's all this discussion about decentralizing our financial markets, just like like the discussion that we're seeing with regards to Bitcoin. And some people are saying this is what we should be seeing, right? We don't want government intervention. We don't want people telling us what to do. We want a decentralized system. And even, even with the discussion with Bitcoin, is it really a decentralized system or is somebody behind it?
I'll take another question from the hand raised, Michael Taylor. All right.
So my question isn't really directed at any of the specific panelists, but my question is more, from my understanding, there's no general duty to disclose unless you can find some rule saying you need to, like you have the 8Ks, the 10Ks, 10Qs, whatever. Do you think in a situation like this, because it seems like GameStop really lucked out that their fiscal year ends February 1st, their 10K is not coming out when all these other companies will, because I would have said like, hey, our numbers are terrible. There's nothing supporting this. And do you think there should be, in this kind of weird scenario where platforms are saying we need to stop trading, this is clearly something's weird happening, the company should have a duty to disclose saying we don't even really know why this is happening, like create some type of duty in that manner, or remain the way it is now?
Nat, do you want to take a crack at that one?
Sure. So I'll be honest with you. That's a great question because I was thinking about it myself. I was thinking, oh my God, if I was on the team representing this company, what would I do? And, you have to be so careful with what you put out there. I think the first thing I would do is probably go to my connections at the SEC and say, hey, what do you think we should be doing with this? I'll be honest. And I myself personally, even when I was practicing, never came across something like this. Okay. So it's a great question. I would need to think about it a little more, but what I would do first is pick up the phone, look at, and I have a lot of classmates that are now at the SEC, and say, hey, what do you think we should do about this?
Great. Yeah, I'll switch over to one of the chat questions, kind of shifting gears back to the Reddit Robinhood crowd. And Brian Quinn, if you want to take a first crack at this one, where the question's asking, do you believe part of the investigation or reform that might ensue as a result of this will focus again on the payment for order flow aspect of everything that's going on, where there's been commentary that Robinhood can offer free brokerage services because they're paying for the order flow, and that information has to be disclosed. And it looks like Robinhood has faced some regulatory scrutiny for it, but it just seems like a clear conflict. And do you think that could use some more reform?
Yeah, I think Jeremy pointed to that as an issue, and Robinhood, I think, was sanctioned by the SEC in December, so recently, for the way it pushed orders. So, I think there's a lot to be said for making broker compensation much more transparent. And if people worry about retail investors basically sitting there on their phone, taking advantage of the gamified aspects of Robinhood and just churning stock, if there were a way to make it transparent to those traders that every trade costs them $1, $2, $3, maybe it might slow them down. It might not change their total volume over time, but it might slow them down, help reduce some volatility. So I think there's a lot to that. And certainly now perhaps customers of Robinhood are a little bit more aware of what their internal relationships are, something that they probably weren't thinking about very hard even 2 weeks ago. So we'll see. I mean, that's a really interesting issue.
I've seen, Professor DeFontenay, you've had your hand up. Do you want to add, or was that from left?
No, I just can't put my hand down for some reason. I do not have that option.
We had, I think, one last question out of the chat was also directed your way. They appreciate your explanation of the value of shorting, and kind of specifically with these GameStop shorts. Do you think this is a good example of shorting's benefits?
Yes, I do. So again, the best case scenario of shorting is that you serve to reveal information to the market that the market wasn't aware of. And you do it by sort of committing to an investment position. You will only make money if the price goes down. That seems to suggest that you believe that the company is overpriced. So you can think of people who buy the stock as in the opposite bet. They believe that the company is in some sense undervalued and the price is going to go up. And so all of this trading in both directions signals information. So a great example of that is before the last financial crisis, so the 2008, 2009 financial crisis. There was one of the big problems, actually, people think, is that the housing market was way overvalued and there was all kinds of securitization of financial instruments tied to the housing market. But there actually was no real way to short the housing market for a long time. And as a result, there was sort of, everybody was kind of reinforcing everybody else's position. The trends were going up and up and up, and everybody suddenly believed that housing prices can never fall, which is obviously incorrect. And it sort of took a long time, but eventually products were developed to sort of find ways of shorting the housing market by effectively shorting those securitized financial instruments. And that signaled information. And one way of putting it is, it would have been better if this information had gotten out much sooner. Things could have been, we could have saved a little bit of the uphill climb, which would have made the crash less painful.
Awesome, thank you. And yeah, I'm mindful of the time Friday afternoon. I want to just thank everyone for tuning in on such short notice with the breaking phenomenon. Thanks to our panelists and all of you listening. It's been a fun time.